what happened in late 79, silver had lagged gold for the entire, it was from August 15th, 1971. Gold took off. Silver lagged. It did go up, but then from November, December, and the first 20 days of January, silver just blew the doors off of gold. And I believe that that same thing will happen. And it was once when the public gets really worried and they're seeking that safe haven. And right now, it's a very small percentage of the public that own gold. Most of the public has absolutely no exposure. Well, and when they try to come rushing in, the only thing that can make up the difference in that's a lot of demand and very little supply. And as the price goes up, the people that own it want to hang on to it more. It's a giffen good.
The silver market is currently noisy. Prices are trying to find a floor, and volatility is keeping traders on edge. However, zooming out, the overall structure still looks bullish. Mike Maloney, a longtime advocate for precious metals, says silver isn't just moving on speculation, it's responding to real inflation, the kind that doesn't show up in sanitized CPI prints. He draws comparisons to the 1970s and early 80s, when gold and silver posted significant gains during sustained inflation and currency debasement. The current setup is arguably even tighter. According to Maloney, most people still don't own any gold or silver. That's a problem waiting to surface. When retail panic hits, and it will, there won't be enough metal to go around. Supply is already thin, and strong hands aren't selling. That's when prices spike. Ray Dalio has echoed similar concerns. As U.S. government debt continues to balloon, he's urging investors to diversify and consider holding as much as 15% of their portfolio in gold and Bitcoin. It's not about chasing returns, it's about surviving the next regime. Meanwhile, central banks, especially those in the East, are taking action beyond mere words. They're hoarding. Gold and silver are flowing out of Western vaults and into Eastern ones. Maloney calls this shift a long-term redistribution of wealth. If the global monetary system resets, countries that hold tangible assets, such as physical metals, will emerge stronger. Jan Uwanowies has closely tracked this trend. Non-Western nations now hold 18,643 tons of gold. That's closing in on the West's 21,470 tons. Eastern countries hold 46% of the world's official gold reserves. That gap is narrowing fast. The buying isn't coming from retail traders in the West. It's central banks, sovereign wealth funds, and institutions repositioning for a future that the dollar won't dominate. Silver's short-term moves may be messy, but the long-term message is clear. The foundations are shifting, and once the broader public realizes what central banks already know, there won't be time to catch up. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, it should be up in triple digits, and it will be.
You think so? Triple digits?
One thing it requires, we were talking about gold counteracting inflation, that it was completely offsetting it, and that what you're seeing is the true rate of inflation revealed. And that's what John Williams believes too. But the public has not come rushing in yet to protect their purchasing power. There will come a day where gold and silver do go into bubbles. And what happened in late 79, silver had lagged gold for the entire, it was from August 15th, 1971. Gold took off. Silver lagged. It did go up, but then from November, December, and the first 20 days of January, silver just blew the doors off of gold. And I believe that that same thing will happen. And it was once gold passed the $400 per ounce level in 79 that the character of how these things were traded changed. And when people were looking at it and going, oh, it was $35 an ounce just, back in 1971, yep. Here it's 8 years later, and it's up at $400 an ounce. It's getting a little expensive. How much is the silver? Oh, yeah. Well, you can get, 50 of those for one of these. Oh, well, give me the silver, Yeah. It's when they change their preference that then silver goes into a super bubble. And I think the same thing is going to happen this time around. So it'll blow way past in my opinion, from studying the last great bull market in the metals, when the public gets really worried and they're seeking that safe haven. And right now, it's a very small percentage of the public that own gold. Most of the public has absolutely no exposure.
Well,
and when they try to come rushing in, the only thing that can make up the difference in that's a lot of demand and very little supply. And as the price goes up, the people that own it want to hang on to it more. It's a Giffen good.
Yeah.
And so as they hang on to it and they don't fill that demand, the price has to go even higher. Going from the west to the east, which saddens me because it ultimately, it really does look like we are headed toward some sort of monetary system that has a link to gold. And the more that heads from west to east will determine how wealthy we are as a nation in the end. And so they're going to end up a little bit wealthier. Yep. We're going to end up a little bit poorer. But what I see too in current demand, you know, I'm a precious metals dealer and I talk with other precious metals dealers, and it's not the West. We're seeing these price rises, and for some reason it is not the Western public that is doing the buying, but the price is going up. It's central banks setting a floor under it with their purchases, and then all of the Chinese demand that you just spoke of. That is what's driving the price. You know, I just spoke here at Limitless. I spoke to the smallest audience that I have had in at least 19 years. There were 44 people in the audience. Yeah. And here, Dana Samuelson, another gold dealer, and I are on this panel. So it's the only gold panel at this conference, and there were 44 people in it. It just wasn't something that the public is interested in yet. But boy, they will be when it's at 5. It's like, you know, I used to say, when somebody would say, well, you know, gold was $250, and 250 when it bottomed, but 300, 400 when I first started promoting it. And people would say, yeah, but I want to stay in the stock market right now for this. Gold's been going down for 20 years. And I'd think in my head, you look like a $5,000 guy. You're gonna wait. It's $300 an ounce now. You're gonna wait until it's 5,000, and then you're gonna buy. Yeah, you've got the manipulation of all the paper, but it's on top of the fact that silver is largely a byproduct of mining copper, tin, lead, zinc, and gold. And but if there's an economic crisis, then and the economy slows down, there's less use for copper, tin, lead, zinc, and gold. They're not building as many homes. They don't need as much wire or copper pipe and so on. And so there's less silver coming to market. Just when everybody is rushing toward it as a safe haven, the supply falls as demand increases. So the manipulation will come to an end, and a lot of people that are on the short side are going to end up going up in flame. I'm trying to take emotion out of it and let math do that for me. So I've got 23 indicators that we're in the process of back testing, and I'm trying to use indicators plus confirming indicators. For instance, the Dow Gold ratio has been an indicator that people have been using for a long time. And we know that if you look at the last bull market, the Dow Gold ratio went to 1. There was a day where gold hit an intraday high of 873, and the Dow was at 873 points at the same time. Yeah. So 1 ounce of gold was worth the same amount of the points on the Dow. They were equal. You take the Dow Gold ratio, and at the same time, that is when the gold-silver ratio did a spike it came from 50 down to 14. So it peaked on the same day. So it's basically a confirming indicator for the Dow Gold. And I've got a whole bunch of them that we're back testing like that. And then we're trying to figure out the weightings. But what I plan on doing is selling a certain percentage, say 20% of my holdings at certain ratios. And then if it doubles again, I've got 80% left that doubled, and I sell 20% of that, and 20% and 20%, and hopefully I can get around that peak. Anybody that says that they can nail the peak is lying, and if they do, it was a complete accident. It was luck.
U.S. equities have bounced hard since April. The S&P 500 is up 29%, while the Nasdaq is nearly 40% higher. On the surface, it appears to be a full recovery. But under the hood, things are less convincing. Mike Maloney points to the Buffett indicator, a ratio comparing the total stock market value to GDP, which now stands at 208%. That means the market is priced at more than twice the size of the entire U.S. economy. Maloney says this isn't healthy growth. It's a distortion. Worse, he argues, the rally is being propped up by just a handful of mega-cap tech stocks. Strip them out, and the market picture changes fast. That concentration is dangerous. When markets turn, it won't be a gradual process. It'll be a rush toward tangible assets. Gold stands to benefit when the chase for yield turns into a flight to safety. There are already signs of stress. The S&P 500 has slipped below its 20-day moving average. Utilities, a classic defensive play, just hit a 52-week high. That shift in sentiment says investors are starting to hedge. Economic data hasn't helped. Weak consumer figures, rising tariff risks, and a Fed that's stuck in limbo have added pressure. Some analysts now expect the S&P 500 to fall to 6,100 as seasonality and macroeconomic headwinds converge. Let's get back to the interview.
I don't think it takes hyperinflation, though, to make gold go vertical. It just takes a big rush toward it. And because there are so few people that own gold right now. And if you look at the average, Rick Rule, I can't remember the numbers, that 8% of the population used to own a reasonable amount of gold, and now it's below 2. And so what does it take to get back to that 8 as far as demand? And I think that the crisis that is coming, like you just said, we've never been this far out of balance before. So to reestablish an equilibrium in the economy, what does that require as far as a correction? One of the things that I sort of proved in my book is that we are living in I think it's chapter 5. Everything is in a bubble. We are in the bubble century. And every time the bubble tries to go back into equilibrium with the rest of the economy, the Fed rushes in to save us, and they pump everything back into a bubble. And you were talking about the number of hours worked to buy a share of the S&P, or one of the things that my researchers found was this real obscure data by a couple of economists in Europe, where they took 17 advanced economies, and they took this back to like the early 1700s. It was the Buffett indicator for the world, going back into the 1700s. And it goes along at like averaging about 30%, the markets being the value of about 30% of the economy, and then just suddenly it just goes haywire. And what is it at right now? The Buffett indicator for the U.S. is at 200 and something?
208 last I saw.
208. Why is the stock market, and mostly just these 7 stocks that you were talking about, worth more than double what the size of the U.S. economy is in a year? This is nuts. It is absolutely insane. It is. We are living in very historic times right now. And, the on-again, off-again tariffs were constantly changing. It has.
Yeah. Let's talk about that.
I know that I have had to put off purchases for my farm, because some of the purchases come from Poland. These mobile chicken coops that we're trying to buy.
I can't wait to hear about that. I want to hear more about that, but keep going with tariffs.
They're supposed to go from 1.4% to 30% on August 1st, but now there's this deal that supposedly is struck, but I don't think anything's signed yet with the EU, so 15%, but that raises my costs by 15% if that goes through. But we don't know if that's going to change tomorrow or not. So business has to just stop and get put on pause until businesses can't operate in an uncertain environment. They have to have something where they can predict what's going to happen tomorrow, next month, next year. And so I see that this perturbation that we're doing to the economy right now should show up in some sort of crisis, something that should happen 6 months, 9 months, a year later. I don't know when, but it has to flow into the economy. What's your thoughts on that? This big bad boondoggle is what I call it. The one big bad boondoggle bill act. How can you?
Which saves nothing, backloads it. So let that, let future
just
people
more
wrestle with that.
Deficit spending, more debt, a bigger national debt, sticking future generations with a bigger bill, and you know that this ultimately can't work out. It's just more borrowed time kicking the can down the road.
Yeah.
And so it's what every other politician has done.
Yeah.
Run on one platform and then completely ignore the promises that you made. So yeah, I am disappointed. I hate to take any. I like teaching economics and letting people make up their own minds. So I typically try and stay away from politics and taking any particular stance. But yes, I'm confused by the actions, especially when it comes to tariffs. My question is, where is Congress in all of this? A president isn't supposed to be able to, the Constitution lays out how the government is going to work. When you read the Constitution, a whole lot of it is really boring stuff about how the government is going to work. Right now, the president is acting very much like a king or a dictator, and waking up in the morning and changing the way the global economy is going to work, according to some idea he had when he was waking up that morning, it's upsetting the apple cart, to say the least.
Gold extended its gains on Wednesday, touching a fresh weekly high of around $3,390 during U.S. trading. The move came after weaker-than-expected economic data raised fresh concerns about the strength of the recovery. At the same time, geopolitical pressure is heating up again. President Trump, who had already threatened massive tariffs on Indian exports earlier this week, turned his focus to Europe. On Wednesday, he warned the Eurozone could face 35% tariffs if it fails to meet trade commitments. Something subtle but profound is shifting. The global monetary landscape isn't just tilting, it's being quietly rebuilt. Central banks are positioning themselves for a world where paper claims lose their power and tangible reserves take center stage. At the same time, cracks in the U.S. economy are becoming increasingly difficult to ignore, even as equity markets attempt to distract with headline gains. Beneath that surface, defensive assets are gaining ground, supply chains for physical metals remain tight, and trust in official data is eroding. When sentiment finally catches up with structure, the reaction won't be mild. How long can confidence in paper markets hold when tangible assets keep signaling something very different? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.